Let's continue with the previous part of that basis of assessment. We studied some of the examples in which first we discussed an example where the second accounting period was ending in second tax year and its length was 12 months. And the second we discussed that the period was ending in second tax year and its length was less than 12 months. Is that so, Benson?
Yes, sir. Correct.
Okay. So now I am going to give you an example where the second tax period would be more than 12. The third situation of the second tax year. Let's suppose if a person starts business on 1st January 19 and he decides to prepare first set of accounts on 30th June, but 30th June 20. Instead of preparing account for 6 months, he decides to go for 18 months account. Let's suppose he prepares accounts on 30th June 2020. And for this is an 18 months period, let me tell you. You can calculate that January 19th, 30th June, 18 months period. So let's suppose the profit for these 18 months are 90,000 pounds. Okay. Then from 1st July 20, because on June 20 period ended. After that, there will be year from June 20, July 20 to June 21, 12 months period. So they earned 72,000 profits. And then from 1st July 20 to 21, 1st July 21 to 30th June 22, the profit was 96,000. So let's suppose this is the situation. Started business on 1st January 19. So first of all, we will apply the first year rule. The first year rule says that from start of trade to coming March. So start of trade means January 19. But before that, I will write my tax year. So my first tax year will be decided from the starting date. January 19 falls in 1819 tax year. So my first tax year would be 1819 and the first tax year profits would be from January 19 to 5th April 19 or practically we will call it March 19. So I will write the March 19 so that it is not confused with the 4 months. Only 3 months profits would be taken. So 3 months profit will be taken from the first period, which are 18 months. So 3 months profit are 15,000. So 15,000 profits will be assessed in first tax year. Any doubt so far to anyone?
No, sir.
Rafi, clear?
Perfect, sir.
Okay, good. So now first tax year was 1819. Second tax year would be definitely 1920. So in 1920, we will try to understand the question. We will try to go through the flow chart. Any period of account ending in second tax year means second tax year. If I take the dates, so the dates are 6th April 19 to 5th April 20. So I am asking in between this period that is there any account which is ending during this period? So I will say the ending date 30th June 20 falls in 2021. It's not 1920. Right?
Yes.
So the situation is different. It is not 1920. So our answer is straight away no. So let's go to that situation. Instead of yes, we have come at a no because the first period was 1819, second is 1920, and my first account, which is ending in 30th June 20, it is 2021. It is not 1920.
Correct.
It is the third one. Which means in the second tax year, I do not have any period ending. So answer is no. In case of no, I will assess the profit of these tax years. Means April 19 to April 20, or you can call it the March 19 to April 20. These 12 months profits will be taken. 12 months profit will be 60,000 because these are the 12 months profit again taken from the first one. Okay. In this case, when this situation occurs, my third tax year would be, this is my first tax year, this 1920 is my second tax year, and 2021 is my third tax year. So in the third tax year, still the period which is ending is more than 12 months because June 20 is the third tax year. So in this case, I will take the last 12 months profit for the third year. Last 12 months means from July 19 to June 20. These are the 12 months. If I count the 12 months of this period, last 12 months, those are July 19 to June 20. Again, those would be 60,000. So you see, I am only assessing 90,000 and I have assessed them 3 times. In the first 3 tax year, the first accounting period is being assessed. The rule, you have to implement the rule simply. First, start of trade to coming March. Then second tax year, ask question, is there any period ending? Answer is no. Then the tax year profit means 12 months profit. And in the third year, again 12 months profit, but those are last 12 months. After that, it will be a current period. In this situation, when there will be a no answer, the fourth tax year will be considered as current year basis. From this, we will start current year basis. Means June 21 is ending in 21-22. So all 72,000 profit will be assessed. Then 22-23 current year basis, all 96,000 profits will be assessed. So if I calculate the overlapping, so you can see 72 and 96 are assessed only singularly, but 90,000 is assessed 3 times. So in total, it is 135,000. So you have assessed 135,000. So it means 45,000 are the overlap profits because 135 minus 90 is 45,000. And which 45,000 you see? January 19 to March 19. If I calculate overlap profits, so January 19 to March 19 is here, right? And then April 19 to April 20 is here. There is no overlapping yet. Up to second year, there is no overlapping because January 19 to March 19 and then April 19 to April 20, no overlapping. But here, you see, April, May, June, July. So July 19 to April 20 is here and July 19 to April 20 is again here. So July 19 to April 20. These are my overlap months, which are 6 and see, in fact, April 20, if not, you will not call it April 20. It is March 20. 5th April 20 means March 20. Okay. So July to March, these are 9 months and 9 months into 5,000 per month profit. So total overlapping is 45,000, which I already told you that you have assessed in total 135,000, whereas your profits were 90,000. So how many extra you assessed? 45,000. So this 45,000 is overlapping and the months for the overlapping are July 19 to March 20. So this is an example of no period of account ending in second tax year. No period of account ending in second tax year. Please, you can take a screenshot for that. Then I will move forward to the next example, in which the third situation we will discuss, where the second tax year would be more than 12 months profit. Done?
Yes.
Let's suppose. Yes, Rafi, have any question?
I will ask you at the end of the class, sir. This is too confusing right now.
Hold on. Once we have understood that is there any no accounting period ending in second tax year, so let's go with the third example. Let's suppose if a person started a business on 1st July 19 and he decides to prepare his first accounts on 30th September 20. So this is a period of 15 months, I guess. So for the 15 months period, the profits are 19,000, 90,000. Okay. Then from next year onward, 1st October 20 to 30th September 21, the profits are 84,000. And then 1st October 21 to 30th September 22, my profit are 96,000. Let's suppose this is the situation. Now, my first tax year is again July 19 comes in 1920. Okay, so first tax year is 1920. So start of trade means July 19 to coming March, which is March 20. So July 19 to March 20 are 9 months. So it means in the first tax year, I will assess 9 months profits. So those are July 19 to March 20. So out of these 15 months, I will take 9 months profits. So 9 months profit would be 54,000. Right? Yes. Then this is 1920 first tax year. So it means 2021 would be my second tax. So I have to see, is there any period of account ending in second tax year? When I say ending, straight away go to the ending dates of all. First one is September 20. September 20 falls in which tax year? Yeah, 2021. So answer is yes. Because I am asking that is there any period ending in 2021? So the first one is yes. Answer is yes. So if yes, then I have to see, ask that how long is this one which is ending? This is for 15 months. This is for more than 12 months. More than 12 months means we will assess last 12 months profit. So last 12 months profit, if I see, those are October 19 to September 20. These are last 12 months profits. So the last 12 months profit would be 72,000 profits, 12 months. Out of this 90,000, we will take 12 months profit. Then from 21-22, it would be current year basis. As I told you, in every situation, but the one which we discussed, when there is no accounting period in ending in second tax year, only in that case, we will still be taking some rules for the third tax year. But in any other situation, from the third year, we will convert to current year basis. Means 21-22, this September ends in 21-22. So the whole 84,000 profits will be. Then after that, 22-23, this September 22 ends in 22-23, so 96,000 and over here. So if you calculate the overlap profits, this 90,000 is assessed twice. So we have assessed 126,000 profits. So it means 36,000 should be the overlap profits. These are the overlap profits. Now the month which are overlapping, those are, we have assessed July 19 to March 20 here. Okay, then July, August, September. It means October 19 to March 20 is here and October 19 to March 20 is here. So these are the 6 months which are overlap. October 19 to March 20. These are overlap months, 6 months. So for 6 months, profit would be 36,000 because it's 6,000 for each month. So this is our overlapping. So continuing with the topic, please, next heading is rules for closing tax year. Rules for closing year of trade, not tax year, sorry, closing year of trade. We have discussed the opening year rules, we have discussed the ongoing year rules. Ongoing means current year basis, and then closing. Let's suppose if a business now plans to close down. So what would be the rules for that? So please write first point this.
Done.
Basis period for the last tax year runs from the end of basis period of the previous tax year to the end of trade. For example, if you have ended the trade on in the same situation, you ended the trade on let's suppose 31st December 22. So 31st December 22. Let me tell you, 31st December 22 also falls in 22-23. So it means in 31st December 22, we will not only assess this profit, but another 3 months, October, November, December, what those are, whatever those profits are, we will assess all these profits in the last year. So that's the basic rule. Next point, overlap profits from the early years of the trade are deducted from the profit of the last year. Whatever overlaps we have calculated, these overlaps will be deducted in the last year of trade. Next point is we have done with this basis of assessment. Now we will start some income tax calculation on partnership. Okay. So let me tell you for the partnership that partnership is also just like the sole trader. So please write under the heading of partnership is income tax is charged on the income of individuals, not to the business. Because partnership is not a separate entity. Legally, it does not exist as a business. So we will charge income to the individuals just as they are the sole trader. Right, next point. Partnerships profit is shared among partners, and then each partner files his or her separate tax return. So what we do in partnership, normally we calculate profit in normal way, accounting profit, which we say. Then in the partnership, you share profits to partners based on their percentage, based on their sharing ratio. You share profit to each partner. So that is considered as a profit from their own individual business. So it's just like treated as a sole trader, and then we will assess the tax as we are doing on the sole trader. We will apply the sole trader rules. Let me tell you, we will not discuss the basis of assessment rules again, but let me tell you, if there are two partners, they have started the business, both partners we will apply opening year rules. If any partner is leaving, there are, let's suppose, four partners, out of them one partner is leaving the partnership, we will apply closing year rules on that partner. The remaining will continue to be assessed on current year basis. So for example, if there are three partners and fourth one joins new, so the partner joining new, we will apply the current opening year rules on that partner, and the remaining will be assessed according to the normal current year basis. But first of all, we will share profits to each of the partners. Then we will decide that which rule will be applied to which partner, which will be assessed under the opening year rules, which will be assessed under the current year basis, and which will be assessed under the closing year rules. So first, we will share partnership profits among each partner. So partnership profit is shared in the following way among partners after following adjustments. So first of all, we will make adjustment in the profit. Then we will share the profit according to profit sharing ratio. What those adjustments are? First, interest on capital is deducted from the profit. Whatever the profit of the partnership is, we will deduct interest on capital. Interest on capital is what all the partners have invested something. So if they have decided that they will be paid an interest on their capital, So definitely this interest will be paid out of the profit of the partnership. So first we will deduct interest on capital. Please write this point. On the second, salaries are deducted from profit. We are talking about salaries of the partners, not the other employees' salaries. Because to calculate profit, they have already been deducted. Partner's salary is not a business expense, but here, before sharing the profit, we will deduct first interest on capital. We'll be given a straightforward figure in the question for the interest on capital. Then salaries will be deducted. So you will deduct the salaries from that profit. Then interest on drawings. If there is interest on drawing, that is added into profit. What is interest on drawing? If a partner has drawn some money, so he'll be paying interest to the business, to the partnership. So that interest is considered as an interest income for the business. That is added into profit. So if there is an interest on drawing, it is added into the profit. So after these three adjustments, remaining profit is shared among partners. Next point, please write. Basis period of sole trader applies to each partner individually. This is what I have already explained, that each partner will be applied, will be assessed individually to see if there is a new partner, we'll apply opening year rule. If there is an ongoing partners, we'll apply current year basis. If there is a leaving partner, leaving the partnership, we shall apply the closing year rule on that partner.
Done.
So next point, please write this point and then I will explain. So it says, if I need your attention, guys, it says, if there is a change in partnership profit sharing arrangement, one, or a new partner joins, two, or existing partner leaves during the accounting period. It happens during the accounting period. And what we will do? The profit sharing calculations will be split between the periods before the change and the period after the change. Let's suppose there are three partners and partnership prepares accounts on 31st December each year. So on 1st January 20, a new partner joins. So we will not prepare a separate account because up to 31st December, whatever those profits are, those will be shared between three partners. And from 1st January 21 to 31st December, next year's profit will be shared between four partners. No problem with that. Or if there are four partners and from 1st January, one partner leaves. So no problem, up to 31st December, profit will be shared up to between four partners. And after that, the next year profit will be shared in three partners. Or if there is a profit sharing ratio, the company prepares account on 31st December and profit sharing ratio is changed from 1st January next year. So still we do not have any problem because up to 31st December, the previous profit sharing ratio will be used, and from January onward, the new ratio will be used to share the profit. Problem arises when it happens, any of this happening occurs during the year, during the accounting period. For example, company prepares account to 31st December each year. And on 30th September 20, one partner leaves. There are three partners. On 30th September 20, one partner leaves. So what we shall do? First, we will prepare accounts from January to September and we will distribute 9 months profits, 9 months salaries, 9 months interest on capital. Everything will be for 9 months between three partners. Then 30th September, the third partner leaves. The remaining 3 months profits will be distributed between two partners. So it means we will we will split this accounting period into two accounting periods, one for 9 months and other for 3. And then we will add after that total profits for the year. For example, for the partners who were continuing partners, we will calculate 9 months profits, then 3 months profits, and then we will add both of these profits and we will assess both of these profits as current year basis. But for the partner who is leaving, his 30th September profit will be considered as closing year profit. So we will assess closing year profits on that partner. So we will practice with the help of an example all this situation. So let point please write same rules apply to limited liability partnership LLP. So let's practice an example for the partnership. Then we will move forward to the next topic, which is pension. Let's suppose there is a partnership in which we have three partners, Mr. A, B, and C. Okay. So profit sharing ratio is like 40%, 30%, and 30%. Partnership profits are year ended September 19. The profits are, let's suppose, 72,000. Year ended September 20, the profits are 84,000. And year ended September 21, the profits are 96,000. On 30th June 19, Mr. C leaves the partnership. On 30th June 20, Mr. D joins partnership. On 30th June 21, or let's change this time the date. On 31st March 21, profit sharing ratio changed as we have three partners now, ABD, A 20%, B 40%, and D 40%. So now these are almost three different questions. We will calculate the profits of each tax year. Now what we have to do, first of all, we have to distribute the profits. So the first profits are year ended September 19, 72,000. But you see, during the year, there is a change up to June. So we will prepare one profit up to June 19, which will be from October 18 to June 19. We will prepare profits for this period. So let's distribute the profits. As you know, the profits for the year are 72,000. So we will prepare October to June, it becomes 9 months. So we will prepare 9 months profits. So 9 months profits are 54,000. Okay. If 72,000 profits are for 12 months, so 9 months total profits are 54,000. Out of those 54,000, we will give 40% profit to Mr. A, 21,600. So we will give 30% share to Mr. B, 16,200 and 16,200. Right? So these are the 9 months profit. After those 9 months, there are another 3 months, which is from July 19 to September 19, July, August, and September. So for these 3 months, Mr. C has left the partnership. And definitely, if he has left, if he has left the partnership, the remaining percentage is not changed. So it means the total profits are now 70%. 40% for A, 30% for B. And how many are the total profits for 3 months? Those are 18,000. So 18,000 profits are for 3 months. So we will consider 18,000 as 70%. 18,000 divided by 70 into 40. So A will receive 10,286 and B will receive 7,714. So these are the total profits for year ending September 19, which falls in the tax year 1920. Okay, so we are calculating the profits for the 1920 in respect of all these partners. So 21,600 plus 10,286. Its profits are 31,886. The profits for Bravo is 16,200 plus 7,714, 23,914, and 16,200 are the profits for the C. Okay. So as if there would have been interest on capital, we would have deducted from individually, first from the 9 months portion and then from the 3 months portion. Because from the first 9 months portion, interest on capital is to be deducted from all the partners who have taken any, from all the partners, because interest on capital, all partners are entitled to that. But after those, the interest on capital should be deducted in the 3 months, only these two. So that's why I told you, you have to perform separate two calculations. Okay. So done this, then let's suppose we are moving to the next situation where C has left and D is joining. Now the next year is which one? September 20 means 2021. But again on 30th June, Mr. D joined. So we will prepare two sets of accounts again from October 19 to June 20. We will split the profit in the existing ratio. Existing ratio, remember, is 40-30. Okay. So 84,000 are the profit. These are for the year. First, I will calculate the profit for 9 months. These are 63,000. So I will split these 63,000 profit in between these two. So 36,000 will be allocated to A. And 27,000 profits will be allocated to B. And still there is no third partner. But yes, from July onward, there is another partner, July 19 to September 19. There is another partner who joined, and definitely he will be joining at same percentage. If the percentage given, you should take the new percentage. But we are not changing the percentage. So he will be joining. So instead of C, now this is a D who will be continuing that. So for the next 3 months profits, which are 21,000 profits are for 3 months. So out of those 21,000, we will give 40% profits to A. We will give 30% profit to B and 30% to D as well. Got it? So these are the total profits for the 1920. So 36,000 plus 8,400, 44,400 current year basis. 27,000 plus 6,300, 33,300 current year basis, because these are ongoing partners. 6,300, and we will apply opening year rule on this D. How the opening year rule will be applied? Thus, this partner has joined from July 19, and
Sir.
only these 3 months profits are there. So we will take these 3 months profits. His first tax year is 1920, but we will be taking these 3 months profits, not only these, but we have to take profits from the next year as well, because we have to go up to March 20, July 19 to March 20. These would be the profit which will be assessed in 1920, not only 6,300, because start of trade, which is June 20 to or July 20, not June 20. On 30th June, we'll consider at 1st July. He joined from 1st July. So July 20 to March 21, we have to take 9 months profits of D in the first tax year. But here we have only 3 months profits. So we will take 9 months profits from 6 months profit from the next tax year as well. So what we will do, we will simply distribute these profits in these three. So whatever those profits are for the D, we will divide it by 12 into 6. We will add 6 months profit into that. Means what, once you get the profit for that D for the next year, you will perform simple calculation as for the basis of assessment. So I'm not taking more time on that. This is how you have to do. This is the basic partnership arrangement which we have already studied in our previous studies. So what you need to do is to split the accounting periods into whenever there is any change during that accounting period.
Sir,
Hold on, please.